their unbiased answers. InvestTalk is made possible by KPP Financial, a registered investment advisor firm serving clients throughout the United States. The clarity for your path forward starts now. Here is KPP Chief Executive Officer, Financial Advisor, Justin Klein.
Good afternoon, fellow investors, and welcome back to InvestTalk. This is our Tuesday, February 6th, 2024 edition. And we have Luke back. Back-to-back days, Luke. You made it. Congratulations.
Maybe tomorrow we'll go for the three-peat again. Who knows?
Hey, I'm a big Kobe and Shaq fan, so I'm big fan of the three-peat. But, it takes a lot of work to do to get a three-peat, and hopefully we can get there tomorrow. But today is the focus, and the focus is you, our listeners, and giving you actionable material so that you can make better decisions with your money. We do that by answering your finance and investment questions, which we love. You can always give us a call, 888-99-CHART, whenever you feel like, 24 hours a day, 7 days a week. And we will answer your question on a future show. So we're going to play some of those and hopefully some live questions as well from our live stream listeners and our radio listeners. So hopefully an action-packed day for all of you. And we're going to talk about the market performance on the day, which was interesting, and run down some show topics. But as usual, we're going to hit our first caller question now.
Hello, Justin. This is Chris from New York. Just want to get your thoughts on the company Vale. Ticker is VALE. I have a 2% position right now. I know it's in a downtrend. Just want to get your thoughts on the company and if I should be adding more. I'll probably wait for it to level off a little bit. I just wanted to get your thoughts, and I look forward to hearing your answer on the podcast. Thank you. Bye.
All right, looking at Vale, I believe that's how you pronounce it. It's a large global miner and the world's largest producer of iron ore and pellets. They also have exposure to nickel, copper, fertilizer, coal, and they have a steel operation as well. And, this is a well-diversified company, very large, $57 billion market cap, but Luke, they're domiciled in Brazil, which adds an extra layer of complexity and geopolitical risk. Although the trends politically in Brazil, could I argue, are looking a bit better, although that's a low bar to get over, right?
It is. Improving is a good word for it, but albeit not as much as probably a lot of people would like. The thing that strikes me the most about this company is it has 50% of its revenue from mainland China. Mm-hmm. So I would imagine, given what's going on in the Chinese economy and depressed demand, certainly below what we thought we would be at coming out of the pandemic, there's been a little hit to revenues, and that's evidenced in their earnings. Earnings per share down from $3 to $2.31, although next year it's projected to be up at $2.59. It's consistent earnings downgrades over the past several months, and their profitability and cash flow has certainly taken a hit since the mid-pandemic 2021 to 2022. So not a lot that I'm seeing that I'm liking here.
Yeah, that's my biggest issue. You're seeing what is happening in China, although they did step in, was that yesterday, to try to support the equity markets more broadly. But in general, the trends in the Chinese economy are just poor, would be generous, shall we say. It's looking pretty bad from a demographic situation, global trade, and I just would not bet big on a company that has, as Luke said, 50% of their revenue coming from China. Now, these are commodities, so certainly they could shift maybe the selling of their raw materials to the rest of the world. So that would be a positive here if they could do that. But the trends overall in earnings, like Luke said, it's pretty bad. $4.05 in earnings in 2022. Last year, once they report fourth quarter earnings, only supposed to be $2.41, down 40%. And when you see that 8.7% dividend yield, remember you are you're taking a lot of risk, and you see that with the recent downturn. Now, I will say technically, it's back around the low teens level where it bottomed out around $12 back in August. And there's certainly a lot of support in this $12 to $13 range. Now it's at $13.41. So yeah, technically there's some support. Maybe you want to wait until that $12, breaking that $12 to get out. But as Luke said, there's not a lot of faith here that this will turn around because the Chinese economy probably isn't turning around anytime soon. All right. Now, we have a lot of ground to cover over the next 40 minutes or so. Our main focus point concerns this story. As layoffs surge, January hiring was a record low for the month. And I think this is interesting because the headline numbers from last Friday and the non-farm payrolls report, but underneath the surface, job cuts are accelerating. So we certainly have to take that into account when you're looking at the broader economic trends. So we're going to look at that. Also, we're going to touch a bit on pharma. And this is the space where there is a lot of landmines, mainly because of patent cliffs. And sometimes these companies handle the patent cliffs well, other times not so much. So we're going to look at a couple of recent examples there. And then next, timeshares. Timeshares. I'm sure we've all been pitched a timeshare once or twice in our life, and we'll talk about some recent trends on timeshare pricing as of late. And then lastly, yesterday, we had the report from the Federal Reserve survey of senior bank lending officers. And as I've said before many times, is most people think money, dollars are created by the Fed or the Treasury or governments creates money. But in the reality, it's about banks, bank lending. In a fractional reserve banking system, it's lending money that creates dollars in the system mainly. And so are banks lending more or are they lending less? So we're going to look at that survey. Now we're going to go into we're going to get some voice bank questions. One is on profit taking and the other on METC, METC, Ramaco Resources. And we'll try to fit in an iTunes review question as well on ticker symbol Lumen. Now we're going into a short break. On the other side, we'll be talking about the market activity for today. Remember, you can call anytime and leave your question on the InvestTalk Voice Bank. If you're listening via our live stream or an AM 1220 radio in the Silicon Valley area, you can call right now at 888-99-CHART.
Every investor is working to build a secure financial future.
Would this be an opportune time to get into annuities?
Everyone's situation is different.
Get your thoughts on CRM, Salesforce.
And so are their questions.
And I was just calling for your assessment of Blackstone Incorporated.
To get your take on QE.
Ticker symbol LECO.
Just wanted to get your opinion on JP Morgan.
InvestTalk hosts Justin Klein.
I'm okay paying a fair price for a very good business.
Steve Peasley.
It's a very well-run company.
And now Luke Guerrero.
EBITDA growth is significantly higher than its competitors.
Are ready to provide their unbiased answers. Each podcast is unique, and you set the agenda.
I will.
Hey, hi, Steve.
24/7, rain or shine, InvestTalk is made better by the power of you. Call 888-99-CHART. Let's take a quick look at your financial to-do list. At the top, make that phone call to the InvestTalk Anytime listener line, 888-99-CHART.
Now, Luke, let's talk about the market performance for today. It was certainly mixed, but positive. Large cap growth was the underperformer after being the outperformer for most of this year. What did you see overall in today's market?
Well, interesting to note that the Chinese equity rally, which was the largest single-day rally since March of 2022, didn't really spill over into U.S. markets today. The market pretty much focused, in my opinion, just on rate stabilization, kind of a bullish talking points revolving around the potential Fed pivot, whereas bears tend to point out that higher for longer is still more of the game, if you will. Maybe you want to rename it stabler for longer, more stable for longer. I don't know, but either way, paused for longer. Either way, there wasn't really much in terms of economic data coming in today. Tomorrow seems to be a pretty quiet day as well. So other than that, just some overall general repricing.
Yeah, you had the Mag 7 stocks, which did well last week. They're starting to come back in over the past couple of days. Still the leader so far this year in performance, but obviously we know that can change, especially if you get the economy reaccelerating or the dollar weakening. And that was, I think, really the news today. The dollar was fairly weak, and you saw the commodity names get a bit of reprieve from that pressure they saw since the Fed meeting, which was at least interpreted by the markets as a bit more hawkish. Now let's talk about, let's go to, what are we going to go to? Our main focus. Let's do a voice bank question. This one came in earlier from 888-99-CHART.
Hey, good afternoon, InvestTalk. I had a question about Ramaco Resources, ticker METC. About a month and a half ago, it has shot up about 125, 130%, and I took out my original investment when it went up that high, and I was just curious on your thoughts for this company moving forward, and I will be listening on the podcast for your answer. I appreciate everything that you guys do. Have a great night.
All right, looking at Ramaco Resources, METC is the symbol, and you wonder, why is Ramaco Resources, why is their symbol METC? Well, it's because they are in the business of mining for metallurgical coal. Met coal is what they typically call it. And this is a small cap name, less than $1 billion in market cap. It did surge up, but it is reversing here. It peaked out in in January, around $22 in change. Now we're at $16.58. So as quickly as this moved from $7 all the way to $22, it's retracing that pretty quickly here. A lot of these coal names, Luke, are trading at pretty depressed valuations, and it surged. Now it's coming back. Has it come back enough to make it worthwhile again?
Certainly, like you said, it's coming back. I mean, its price to book is still 2.5 relative to its 5-year average of 1.4. Its price to earnings is well above its 5-year average as well. It's got quite a bit of debt, $139 million on a $900 million market cap. It's set to make less money in 2023 than it did in 2022, and less money in 2024 than it did in 2022 as well. Its cash flow is pretty stable, but its profitability kind of took a hit. One thing that's of note to me is there's about 10.7, so nearly 11% short interest. I think there's still some room for this thing to come down.
Well, I think the short interest to me is more of a product of the industry that it's in. There are a lot of people that are shorting just coal in general, just because it's an anti-environmental bet. That ESG will push investment into these names out, and that there will be higher cost of capital for names, right? If they have to refinance that debt, that will go up, et cetera. So I wouldn't worry too much about that, but I would worry, like you said, the kind of trend in profitability, trend in earnings, which is not fantastic, even though their sales are pretty solid. Like their sales are fine, but why is profitability shrinking? Is because just their overall cost to run the mines are increasing? Is that labor? Is that the energy that goes into it? What is that? And that's what worries me there. So from a technical perspective, there is support around $15. So if you wanted to pick up more, that's around the 100-day moving average, the 50% retrace from this recent move, and that is good support. But beyond that, I think you find better coal names out there besides this one. Thanks for the call. 888-99-CHART, 888-992-4278 is how you get through and ask your question on today's show. We're going to head into our first major break for the hour, and we're ready for your call. So give us a call now at 888-99-CHART.
Every investor is working to build a secure financial future. How they get there and when they get there, that depends on many variables. The more you learn about how the market works, the better your chances. So don't forget to call InvestTalk, 888-99-CHART.
Now, our focus point today concerns this story. As layoffs surged, January hiring was a record low for the month. Despite the big headline numbers, if you actually look at the report from Challenger Gray, it showed the highest level of job cuts in January since early last year. The job outplacement firm, that's Challenger Gray, said planned layoffs totaled 82,307 for the month, up 136 from December. Now that sounds like a lot, but most companies don't really lay off anybody in December. It's the holidays. You don't want to tell people. You don't want to give them a pink slip as they're going to the holidays. They usually wait till January, so that's very common. But it is down 20% from the same period a year ago. So, while they're up from recent trends, they're down from a year ago. It was the second highest total layoff since 2009 in January. So you can see that there are sectors like technology, finance were the hardest hit. Microsoft, Alphabet, and PayPal all announced layoffs. Amazon as well. UPS said it's the biggest month for layoffs since March of 2023. And I think that's underreported, Luke, about this surge in the Mag 7 is that, business was fairly good, but remember, markets like layoffs. They love cost cutting, and that was really the main driver here for most of these businesses is that they were just right-sizing their staff for a slower economic environment.
Yeah, that certainly seems to be the case. I mean, the most surprising part about that is the food producers announcing 7,000 cuts, highest since November 2012. Because if you think about what happened during the pandemic, I'm not surprised that there are tech layoffs or financial sector layoffs. There was a lot of capital, there was a lot of stimulus, there was a lot of money running through the economy. People would just hire anybody who could code to be at a tech firm. From a financial perspective, the amount of excess capital led to good deals, but now deal flows kind of dried up in the investment banking arm. Goldman Sachs, which earlier in the year announced it would have its largest layoff since, I believe, the financial crisis, said most of it's focused in their investment banking division. So I think even within these digging past the top line number of the jobs report and seeing the sector breakdown, I would be interested to know, and I don't know offhand, within finance specifically, where are these layoffs coming from? Again, tech makes sense. I still believe that they overhired during the pandemic. Finance, I wouldn't be surprised if it's focused within the investment banking divisions.
And mortgage industry.
And mortgage industry, yeah.
Yeah, and how much is this driven by AI adoption? I'm sure there's some application there, but probably not the main driver here. Like I said, it's probably cost cutting. Now, what makes me believe this a lot more than that headline on Friday, which 319,000 jobs? Was that the headline? Something like that. Much higher than expected. And that made the market pivot towards pushing out a rate cut even farther, strengthening the dollar, etc. What makes me believe this data from Challenger Gray is the continuing claims. Because if you look at that, it actually resurged to the highest level. Let me pull this up. Almost the highest level in the last 12 months. The last time it was this high was at basically 1.9 million continuing claims, which was higher than December, the peak in December. It was just shy of mid-November, it was at 1.925 million. So, 25,000 jobs basically shy of the high of this cycle of continuous claims. And so if that continued, that was up 90,000 just last week. Okay, so this is what I'm watching. It's not about, as I've always said, it's not about how many people file for unemployment in any given week. It's how many of them stay unemployed for an extended period of time. And so I'm still in the belief that the job market is clearly weakening and will precipitate a Fed rate cut. But, I think the reality is somewhere in between this number and that rosy number that we got on Friday. Now let's go to Jeff in Alabama. He wants to talk about SHEL.
Good afternoon, Justin. Thank you for taking my call. I'd like to let Steve know that we're thinking about him in our thoughts and prayers.
Appreciate that.
We miss him.
I will pass on the message.
Yes, SHEL. I was going to see about making an investment in SHEL, and I wanted to get your fundamental analysis and technicals, and let me know what you think about it.
Well, the first thing when I look at the chart on SHEL is I think it's remarkably strong compared to the broader big oil names, Exxon, Chevron, etc. So I like that outperformance. Its relative strength is at 45, kind of middling compared to the overall market. Exxon's only at 27, and Chevron is at 32. So I like that. Now, SHEL is more globally diversified. It's obviously a UK domiciled company and 4.1% dividend yield. But we're going to go to a quick break. Luke and I are going to look over this, and we'll get to our full answer at the other side of this break. Now, next Invest Talk, I'll look into the question, is the market in a dangerous position? That story tomorrow. But for now, I'm Justin Klein with Luke Guerrero, and we're ready to take your calls at 888-99-CHART.
In today's market, more than ever, you need unbiased investing guidance because it can help you achieve financial freedom. Well, you've come to the right place. InvestTalk, 888-99-CHART.
Now, before the break, we were talking to Jeffrey, and he was asking about SHEL, the large integrated oil and gas company domiciled in the UK. $212 billion market cap, Luke. They just had earnings. They beat expectations by a bit. What I liked here was they have a big buyback program, about $3.5 billion a quarter, which is very large. They returned 42% of their cash flow to shareholders for the full year 2023. That's above their 30 to 40% distribution guidance. So they're really taking this cash flow and giving it back to shareholders in a big, big way. They're also reducing costs, and they reduced that by about $1 billion last year. So I really like what's happening here, and I would give this a thumbs up in my mind.
Yeah, I think Shell's a fine company. It's pretty fairly valued. It's trading at its book value. I think the thing that probably gives me some pause is that its margins are just not great compared to other companies within the sector. I mean, its net margin was 7.6. Exxon was 10. Chevron is 12. It has twice the debt of Exxon at half the market cap. I think there's probably, in my opinion, some better oil and gas names out there that have better margins, more margin for error with less debt, but I don't have anything against Shell personally.
Yeah, maybe that's why they're trying to cut costs. And
they have been successfully doing it, and there's obviously been a positive market reaction as evidenced by where it's been trading recently.
Yeah, and the new CEO is focused on shareholder returns, which you always like that. CEOs that are focused on those aspects of the business means that they're not going to do foolish things with shareholder money, which happens a lot in corporate America. Let's go to Roger in the Bay Area looking at APD, Air Products and Chemicals. Down big on recent earnings. Do you own it or looking to buy it?
I own a small portion of my portfolio. I felt the stock was pretty hammered yesterday after a weak guidance. I feel the reaction to the stock news was a bit overdone. I wanted to know your take on this. Like, is it a good point to actually buy more or just cut your losses and get out of it?
Well, from a technical perspective, it is at the lowest level in the last couple of years, right at the support that it found in 2022. And their earnings were, they certainly missed. Down 6% in revenue year over year. Earnings were down 3% year over year. And that's after consistent growth and consistent increase in sales and profits. And now, then this is a perfect example of when you have the market pricing in a premium to a name because of consistent growth, and then that growth disappears or disappoints, the stock can drop dramatically. And that's what you... As it corrected enough. Now it's trading at about 19, 20 times earnings, backward-looking earnings, which is, about the market multiple. They do have a little bit of debt here, Luke. Is it cheap enough in your mind with a, price to book, 3.3?
It's trading at the sector average in terms of its multiples. Its price to earnings on a forward-looking basis is around 17 times. Kind of expensive. Wouldn't say it's egregiously expensive. I'd say anytime you have a big move like this, let me pull this back on like a 2-year real quick. Anytime you have a big move like this, you want to have it kind of figure out where it's going to be. This could easily move lower. It could easily move higher. But either way, I would wait a little bit, see what happens in this price discovery phase. I think it's probably trading at a fair value. But like you said, this is another example of the market expects something given history. When something changes, you're going to have a big move like this.
Yeah, and you said price discovery phase, and that's common. Everyone thinks that the market is this magic efficient place, and the reality is it takes some time for there to be price discovery, and that usually it takes at least 3 days, and often many weeks for it to settle out. And so far, it's just been kind of trading here right around this 220 level, and that is major support. It's the 100-month moving average. Am I correct? Oh, sorry. Yeah, 100-month moving average. So that's first time it's hit that since 2012. So over a decade. And it found the support here once, which means that this support is actually going to be less strong. The more you hit on a price support level, the higher odds that it breaks through. And if it kind of stays around this 220 level for long enough, it will break through. And I will say the next major support is down around 184. And so I would be very patient on it. At 184, I'd probably relook at it because it is a good business. And you probably need a few quarters to see how much of a problem this current economic environment is for this name. And clearly, it's not good. All right, let's talk a bit about the pharma industry. And AbbVie was an area, still is a name, that has been dealing with patent cliffs. And there are many companies, large, multi-billion-dollar pharma businesses that are reliant on a handful of drugs that really drive their sales and their profits. And when they go off patent, suddenly that can be huge risk. And Humira, which is the blockbuster drug from AbbVie, it used to be under Abbott, and there was a spinoff. AbbVie was a spinoff of Abbott. And in total, it grossed about $200 billion in revenue throughout its lifetime, and it's still producing revenue today. But what's interesting is AbbVie's strategy as this went off patent in 2022 is how they were going to deal with these biosimilars. And they've done that by applying for a lot of patents of various delivery mechanisms to kind of protect themselves from their competitors on different manufacturing processes, for example. And that's keeping the drug still pulling in billions here. So, Luke, can all of these drug companies navigate their patent cliffs as seamlessly as AbbVie has?
I mean, they certainly could until something changes from a regulatory legislative perspective. I think the AbbVie benefits from being a massive company with an army of lawyers. Certainly a lot of pharmaceutical companies that have been reaping in the benefit of their patented drugs have that ability as well. But I think overall, the point of these patent expirations and getting generics into the market is to lessen the cost to consumers of some of these drugs. And so if through legal means companies are able to skirt what has historically been the norm within the pharmaceutical industry, I think everybody can agree, even in a Congress such as this, that can't agree on how to put your pants on, doing it one leg at a time. That voters are going to probably want cheaper drugs.
Yeah, and does this also? Is there a level of regulatory capture that this is pretty much exhibiting? The fact that they're able to, and AbbVie's not just the only one. Merck's doing this, and there are other drug companies that are taking the existing drugs, kind of finding ways to file patents for different uses, manufacturing processes, delivery mechanisms, etc. But the overall drug, that hasn't changed, right? The technology of what they developed hasn't really changed. So, will that regulatory capture change anytime soon, or is this something that you can basically count on these drug companies being able to navigate because they just need to spend a few $1 million on lobbyists?
Yeah, I mean, frankly, you can count on this being how it's going to be for a while.
Yeah, unfortunately. Yeah, so it's going to be interesting to see how this evolves. Obviously, there was the recent I forgot what bill it was that Medicare was able to negotiate on 10 drugs, was it? And it's going to be 10 more each year, but there are thousands of drugs out there.
Was it part of the IRA?
Yeah, I believe so. I think there will be some creep here to push drug prices down. But what's most interesting about the Humira case and the AbbVie case and the Merck cases is that it's not really about that as much as it is being able to create new patents that enforce their lock on the market and their profit margins for extended periods of time and on various types of use cases for these drugs. And so you can push down on the cost of one from one particular use case, but it can always be used in other ways as well. So it's pretty interesting to see how the lawyers are maneuvering around a lot of these patent cliffs, and they're finding new ways to do it. So that's why you're seeing a lot of these drug companies near all-time highs, because they're starting to figure out how to create that regulatory capture. And it'll be interesting to follow that to see if that sticks over the long term. Now, when people take the time to leave an InvestTalk podcast review on iTunes, we'd like to thank them for the courtesy by getting to their questions quickly. Beirut Don says, Justin, my son Matt from Jordan recently did a portfolio review with you. I don't think you have talked about Lumen in a while. Just curious if you see any catalyst that will turn the ship around. To me, it isn't a technical question, but one of leadership. I understand this is a speculative play and will take 3 to 5 years to pan out. But what are your thoughts on the long-term position? 67% institutional ownership and some insider buying. And our best to Steve. Thanks for that, Beirut Don. Now, Lumen is a name that has been shrinking, and it's been shrinking by trying to right-size its balance sheet, selling off assets in order to pay down debt. And the market has determined that the value of what's left is not enough to likely keep them in business. And ultimately, that's the issue. Their free cash flow now is negative. If you look back just a few years ago, it was over $4 billion in 2021. Now it's negative $900 billion. So, and they're still under the weight of about $20 billion in long-term debt. It's trading at $1.36, I think, for a reason. This is the market's telling you that this is going bankrupt. Do you see anything else here, Luke?
It doesn't make money. Stay away.
Yeah. Yeah. Simple. I think they talked a big game and weren't able to execute on it. They wanted to sell off assets and they believed that their assets were worth enough to get the balance sheet in a more sustainable situation, a more sustainable path. Clearly, that's not the case. They have not been able to right the ship. And while the technicals are slightly improving recently, not a name I would bet on longer term. Now let's pivot back to the InvestTalk voice bank for a call that came in earlier on 888-99-CHART.
Hey, Justin and Luke. Joe from South Carolina here. Just calling, wondering what you think of UPS, United Parcel Service. Stock's been going down for a while, but I see their business as one that has a high barrier to entry just because it's really just them and FedEx and USPS. Just wanted to see what you think of it. I think it could be a good value here and wanted to see if you agree. Look forward to listening for your answer on the podcast.
We're looking at UPS recently announced earnings and disappointed the markets. Was trading at about 158, now trading at 145 and change at the close today. They had disappointing guidance for the full year. We talked about them doing a bit of layoffs. But Luke, I kind of agree that at a certain price, UPS is a good bet because of that duopoly or triopoly, would you call it, between them, FedEx, and United Postal Service. So this is a name that interests me for sure. 4.6% dividend yield. But do you bet on it yet? Is it cheap enough yet? Kind of on the fence here.
Yeah, I think it's pretty reasonably valued, to be honest. I mean, it's trading at about 16 times next 12-month price to earnings. It's trading a little bit more than it has over the past 5 years. It's priced to book value, so I'd maybe wait for it to come down a little bit more. But one thing about UPS versus FedEx really is that generally speaking, UPS has a stranglehold on delivering Amazon packages, which accounts for a lot of packages being moved around this country. So I think that's one benefit it has over FedEx. And you know, the caller was correct in that there are barriers to entry for this business. I don't expect another player to come into the mix anytime soon. I'm with you. I don't think it's quite cheap enough right now, but at a certain point it will be, and it seems to me like that's going to be pretty soon.
Yeah, from a technical perspective, I will say, around this 130 to 140 range is pretty good longer term support. If you go to a monthly chart, it's right around the 100-month moving average, which is typically in a good market, in a bull market, where it tends to find support. So I do like that. I like that they're buying back shares. They're paying out a dividend. I do think that dividend is a bit stretched. Its payout ratio now is 80%. Its cash dividend payout ratio is 105%. So I don't think the dividend is going up anytime soon. But they do have a very good balance sheet compared to their market cap. Their times interest earned is 12. So I like that about it. I don't think it's a terrible bet at these prices. I like good businesses at a fair price than a poor business at a cheap price. So, I think that's what this qualifies as a good business at a fair but not cheap price. Thanks for the call. Now, listen to InvestTalk. I'm Justin Klein. We have one goal each and every weekday, and that's to help you achieve your own version of financial freedom. And our work continues after this final break. So if you're going to call, you want to do that right now at 888-99-CHART.
No two portfolios are alike, and every investor has a unique set of circumstances. So don't forget to call InvestTalk. 888-99-CHART.
Hi, Steve, Justin, and Luke. Hey, it's Matt, longtime listener of the show here from Minneapolis, Minnesota. I'm obviously have some cash on hand because I've done some profit taking. I know you say take profit taking after maybe your portfolio or in a stock you get over like 8-10% in that specific one. Is there a certain amount you should take from a stock? Should you just take 3-4% automatically, or how much should you take? I know usually I try to wait until after a year for capital gains and tax reasons, but I'm just kind of uncertain on how much to take or when exactly to take profit. Thank you for your help. Have a good day.
Well, this is pretty simple. You take as much as your portfolio target is. What do you want that position to be in your portfolio? 2, 3, 4, 5% of your portfolio, whatever that is. And you have to look at your portfolio as a whole. What is your sector allocation to that particular sector? Do you want to have it at a certain level for a particular reason, et cetera? So it's really about the target. You want it as a percentage of your portfolio. Thanks for the call.
Great advice. Now, Justin, I know you and I are very excited to talk about this next topic, primarily because I love informing our listeners about terrible investments. Mm-hmm. And this one may take the cake, and it is as old as time, and that is timeshares.
Yes.
Now, for anybody who doesn't know what a timeshare is, essentially you pay a bunch of money and you get a certain amount of time that you're able to use a property or properties. I know back in the day, you maybe had a timeshare for one vacation rental, but now companies like Marriott and hotel companies actually give you timeshare credits that you can use at any of their properties. Now, for me, timeshares are an interesting thing that some people call investments. I had a former coworker who used to take advantage of the timeshare salespeople who would give free vacations at one of the properties if you sat in on a couple meetings. Mm-hmm. And one of them, I'll never forget, told him that you can think of a timeshare as a, get this, 401v, your vacation retirement plan.
Wow. Think of the brainstorm meeting that somebody came up with that. And I guarantee he's the only one using that term.
And he didn't know that my former coworker managed mutual funds and would take a lot of offense to having this being called a 401v. But essentially, where we are now is a lot of people decided they wanted to buy into timeshares. And now a lot of people are finding out that they can't get out of those timeshares because you're not just paying for the right to use the property, you're paying for the upkeep and there's annual fees. And a lot of people have found themselves in quite a bit of a hole, isn't that right?
Yeah, they've taken on debt to do it, which is pretty crazy. And these were bad investments before Airbnb and VRBO, and they're even worse now. And what's so crazy is that in 2022, the average transaction sales price for timeshares were nearly $24,000 when bought directly from a developer. But as you said, if you go on Sell My Timeshare Now, you can find thousands of these for free, basically $1. Some of them are $0 because people just want to avoid that monthly maintenance cost.
Some people are essentially paying you to take it. They're saying they'll pay the transaction fees, they'll pay X amount of the first year. Mm-hmm. It's interesting to me that if I see something that somebody is telling me is an investment and they're going to give it for me for negative money, meaning they will pay me to take it, it's probably not something you should do.
Yeah, and what's interesting is that Marriott is one of many of these timeshare companies that operate these properties, and they actually have first right of refusal. So a lot of times they're buying these for basically nothing back from the people they sold them to for tens of thousands of dollars and then reselling them. And so that's actually something they're doing to recycle that. It's a great business for them. But obviously in today's world with just the plethora of options for a vacation, nobody should be buying a timeshare for any reason whatsoever. And so don't ever allow anyone to convince you that these are good investments. They are some of the worst investments you could ever make in your life.
A 401v does not exist.
Only in someone's mind. All right, well, I'm Justin Klein with Luke Guerrero. This completes another InvestTalk program. We thank you for listening, and we encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. Independent thinking, shared success. This is InvestTalk. Good night.
InvestTalk is a trademark of KPP Financial. Because of the nature of the interactive dialogue inherent in the format of this program, it's important for the listener to understand that not all comments made will apply to them. Specifically, nothing said shall be taken to be investment advice, or shall statements on this